This content is for educational purposes only and is not financial advice. Somewhere right now, someone is scrolling through their phone. They see a video, a young person standing next to a rented car or a stack of cash on a hotel bed. The caption says something like, "I turned 500 into 10,000 trading currency. And you can too." It looks real. It sounds confident. And it's designed to make you feel like you're missing out on something everyone else already knows. But U.S. regulators, including the Federal Trade Commission, have spent years warning about exactly this kind of message. Not because currency trading doesn't exist. It does. Banks, governments, and large institutions trade currency every single day. The warning is about something else. About how ordinary people are being pulled into promises that don't match reality. By the end of this video, you'll understand exactly how these claims are built, why the math almost never works the way it's advertised, and what regulators say you should watch for. Let's start at the beginning. The claim itself is simple. It goes something like this. Currencies move up and down every day. If you know the pattern or have the right signal or use the right bot, you can profit from that movement consistently and grow small amounts of money into large amounts. This isn't a new idea. It's just wearing new clothes. Foreign exchange trading, often shortened to Forex, is one of the oldest markets in the world. Governments, corporations, and banks trade currency constantly for very practical reasons like international business and hedging risk. But somewhere along the way, this real market became the backdrop for a very different pitch. One aimed not at institutions, but at everyday individuals looking for a way out of debt or a way to build wealth fast. That pitch usually shows up in a familiar setting. A message from a stranger on social media, an ad promising a proven system, or someone you match with on a dating app who happens to be a successful trader. The Commodity Futures Trading Commission, which oversees currency and derivatives markets in the U.S., has published repeated advisories about this exact pattern, describing how offers to trade Forex, precious metals, or digital assets are increasingly delivered through social platforms and private messaging apps. So before we go further, here's the question worth sitting with. If currency trading is really this profitable and this easy, why does it need to be marketed to you by a stranger online? That question is where the real story begins. To understand the scam, you first have to understand the real mechanics underneath it. Currency markets move based on interest rates, economic data, geopolitical events, and the actions of massive institutional players. That movement is real. What's misrepresented is the idea that an individual, using a signal group, an app, or a proven strategy, can reliably predict and profit from that movement. Here's how the pitch usually escalates, step by step. Step 1, contact. It starts casually, a comment, a message, a match. Trust is built slowly, sometimes over weeks. Step 2, the introduction to trading. The person is introduced to an unfamiliar trading platform or app, often one the victim has never heard of, and often one that isn't registered with U.S. regulators. Step 3, the small win. An initial deposit is made. The account appears to grow. Sometimes a small withdrawal is even allowed, just enough to build confidence. Step 4, escalation. More money is requested for taxes, fees, or to unlock larger returns. Step 5, the wall. When a victim tries to withdraw significant funds, problems appear. Delays, fees, excuses. Eventually, contact stops entirely. The CFTC has described this exact structure in its consumer advisories, noting that many of these platforms have no real trading happening behind them at all. The numbers on the screen are simply invented. Here's the part that surprises people most. The technology used to sell this illusion, charts, dashboards, account balances, often looks completely legitimate. Some of it is genuinely well designed, which raises an uncomfortable question. If it looks this real, how is anyone supposed to tell the difference? We'll answer that. But first, Let's look at why the underlying promise almost never survives contact with real markets. Let's separate two things clearly. Currency trading itself is real. The claim that ordinary retail traders can consistently and reliably profit from it is a very different statement. And this is where regulators push back hardest. The CFTC has stated plainly that the Forex market is dominated by large institutional participants, banks, corporations, and governments, with individual retail traders making up a very small share of total activity. The agency has also noted that a majority of retail foreign exchange traders lose money in a given period, underscoring how difficult consistent profitability actually is, even for people trading through fully legitimate channels. That's an important distinction. Losing money while trading through a real, registered platform is a normal risk of markets. Being told your money is growing on a platform that isn't real or isn't registered is something else entirely. That's fraud, not bad luck. Regulators have also directly addressed the tools often used to sell these claims. Things like automated trading bots or signal services that promise to predict market movement. The CFTC has noted that even when such tools are built using historical data, there's no reliable way to guarantee that past patterns will repeat in future market conditions. In other words, no software, no signal group, and no insider system can remove the fundamental uncertainty of financial markets. So if the underlying math doesn't support guaranteed returns, and the regulators who monitor these markets say it doesn't, then the obvious question becomes, why do these claims keep spreading anyway? Who benefits when people believe them? That's where we go next. Here's something worth understanding clearly. Not everyone promoting these opportunities is lying to your face. Some genuinely believe the system works. But the underlying business model often rewards promotion regardless of results. The FTC has specifically warned about coaching and training programs that promise to teach people how to succeed by investing in markets like Forex, crypto, or precious metals. According to the FTC's own consumer guidance, these programs are frequently sold with claims of guaranteed income or a so-called proven system to make money, phrases the agency flags as red flags, not credentials. The financial incentive is straightforward. A course, a signal group membership, or a coaching program can be sold to thousands of people. The seller earns money the moment someone pays, regardless of whether that person ever profits from trading at all. This is why testimonials and success stories deserve real scrutiny. The FTC has specifically cautioned that glowing reviews and success stories tied to these offers can be fabricated, exaggerated, or posted by accounts that don't represent real customers. There's also a documented case worth knowing about. In 2020, the FTC took public action against a company called Online Trading Academy over its money-making claims tied to trading education. Programs the FTC noted carried price tags reported as high as $50,000. That case is a useful reminder. The promise of learning to trade like a professional has, in the past, been sold at prices far beyond what most people would spend on any other kind of education, with results that regulators found didn't match the promises made. So the question shifts again. If the seller profits either way, who's actually carrying the risk? This isn't a fringe concern. It's something multiple U.S. federal agencies have addressed directly in writing repeatedly. The CFTC, the primary regulator of Forex and derivatives markets, has published customer advisories specifically warning about Forex, precious metals, and digital asset scams that begin on dating apps and social media. It has also issued a list of warning signs for spotting fraudulent trading websites, including platforms that aren't registered to trade Forex at all. The FTC, meanwhile, tracks and reports on investment scam losses more broadly, including scams that use Forex and crypto as the hook. According to FTC data, Americans reported more than $7.9 billion in losses to investment scams in 2025 alone, with a median individual loss of over $10,000. The FTC has also reported that losses tied specifically to scams originating on social media have grown sharply since 2020, with 2.1 billion reported lost in 2025 through that channel alone. Regulators have outlined consistent warning signs across their advisories. Among the most common, being pushed to move a conversation off the original platform and into private messaging, being promised outsized, guaranteed returns in a short period of time, being directed toward a trading platform with no U.S. registration and no physical presence, being told there's no downside, no bear market to this particular opportunity. Any one of these, on its own, is worth pausing over. Together, they form a pattern regulators have flagged again and again. And that pattern doesn't stay abstract for long. Behind every one of these warnings is a real person who didn't see it coming. It's easy to talk about this in terms of percentages and advisories. It's harder, and more important, to remember what's actually being lost. The CFTC's own advisories describe romance-based Forex scams where victims believe they were in genuine, months-long relationships before being introduced to a trading opportunity. In many of these cases, the agency notes funds sent overseas are extremely difficult, if not impossible, to recover. That detail matters. This isn't only about losing money. It's about the aftermath, the trust that was built and then used, the confidence that was drained alongside a bank account, and the isolation many victims feel afterward because these schemes are built specifically to avoid detection by friends or family until it's too late. We are intentionally not naming or detailing individual victims here out of respect for their privacy. Verify source for any specific personal account, since no verified individual case is being cited in this script. What we can say, based directly on regulator language, is this: these losses are rarely just financial. They involve a breach of trust that was deliberately engineered. And that engineering is precisely what makes this kind of fraud so effective. Which brings us to the most useful part of this entire story. Not just what to avoid, but what actually makes sense instead. So if guaranteed return trading pitches don't hold up, what does a more solid approach actually look like? Regulators themselves point to a few consistent, practical steps. First, verify registration before anything else. The CFTC and FTC both recommend checking whether a platform or individual is actually registered to trade Forex or offer investment services in the U.S., not simply taking their word for it. Second, treat guaranteed returns as a red flag, not a selling point. Every legitimate financial regulator that discusses investing repeats some version of the same idea. Real investments carry real risk, and anyone downplaying that risk is not being straight with you. Third, slow down before sending money. The FTC specifically advises talking to someone you trust, a friend, a family member, even a licensed financial advisor, before acting on any high-pressure investment pitch, especially one you were introduced online. Fourth, research independently. Search a company or individual's name alongside neutral terms, and check their background through public tools rather than relying on testimonials provided by the seller. Fifth, understand what legitimate participation in currency or financial markets actually looks like. It generally involves registered brokers, transparent fee structures, and realistic expectations about risk, not private signal groups or unregistered platforms promising shortcuts. None of this is exciting advice. It won't fit neatly into a highlight reel, but it's the version of this story that regulators consistently point to, and it's the version far less likely to end in the kind of loss we just described. So where does that leave us? Here's what this story really comes down to. Currency markets are real. They're enormous, and they move every single day for reasons that have nothing to do with any individual trader. What regulators like the FTC and CFTC have consistently warned about isn't the existence of that market. It's the gap between what that market can realistically offer an everyday retail participant and what certain online pitches claim it offers. That gap is where the loss happens, not in the market itself, but in the space between a confident promise and an unverifiable platform. If there's one thing worth remembering from everything we've covered, it's this. Legitimate opportunities don't need urgency, secrecy, or a stranger's encouragement to convince you they're real. They can withstand a slow, careful look. Scams generally can't. If you want to check whether a company or individual is registered, or if you've encountered something that matches what we've described here, both the CFTC and the FTC maintain public reporting tools, CFTC's registration check tools, and the FTC's report fraud.ftc.gov. Before you act on any investment opportunity, online or otherwise, pause, verify, and talk to someone you trust. This content is for educational purposes only and is not financial advice. Thanks for watching.